Okay. 4 chapters, but this chapter really doesn't exist. I'm not even sure it's in the syllabus, but it just has a few definitions that are useful as we go through some of the other work we're doing. So just going to talk about definitions. You don't have to focus on anything besides what's on these slides as it relates to chapter 18. Okay? So it's 5 minutes and we're done. Spoilage, rework, and scrap. We'll define them. We're not going to do the accounting stuff. Spoilage. So you produce your goods and they're not up to specification. You can't fix them, so you have to either get rid of them or you throw them out or sell them for some significantly reduced price. That's what spoilage is. So it's not worth trying to fix, and you have to dispose of them. Rework. These are also units of production that don't meet specification, but they can be fixed. So there's some extra cost to get them ready to sell. Scrap. It's material that's the byproduct or the result of whatever your manufacturing process was. So if you're building something out of wood and you have kind of wood shavings and stuff like that at the end, you can make some money by selling the wood shavings to a paper company that will use it to make paper pulp. So it has some value, but it's a low value compared to your primary product. It is not the purpose of your manufacturing process. It differs from waste because scrap does have some value. So I guess we'll do a little bit on the accounting of spoilage. You know what? We're not going to do this. We're done with chapter 18. Just wanted to do the definitions. You should know how to account for them, though, but not for our test. Okay. Before the midterm, or actually after the midterm, we did chapter 15. You guys were very engaged. I remember it well. Never thought I saw more blank eyes in my life. When we're talking about how do you allocate from a support department to an end product producing department. Today, in chapter 16, we'll talk about how do you allocate joint products. So you have a single raw material, maybe crude oil. That crude oil is processed, and some of it becomes gasoline, some of it becomes kerosene, some of it becomes asphalt, different kinds of outputs from the individual raw material. Crude oil, which costs, let's say, $100 a barrel. How do you allocate the cost of the crude oil to your various end products? And that's the purpose of what we'll talk about right now. So first we'll define what joint products are and byproducts. I've kind of defined them already. Then we'll talk about 4 different methodologies. There is always more than one way to do things in order to allocate your joint costs. Sales value at split off, net realizable value. We're not going to really focus on constant gross margin % of net realizable value. And then we'll talk about physical allocation. We'll talk about how do you select which model is the right one for a given situation. And then we'll end up by just talking about byproducts a little bit. So to understand that a main product is the purpose of your your production processes. It may be more than one main product. Coming out of crude oil is more than one main product. Any product is anything that has a positive sales value. The value can be high or low. So scrap is, in fact, a product, if you would. Byproducts are products. So a joint product, as I described before, is when you yield two or more products from a single raw material or single process, and those products will all have a high sales value. They may not have equal sales values, but they are all meaningful sales values. So they're all more than scrap. They're all more than byproducts. Those would be joint products. One thing you can see as you break down crude oil is that some of its products come in a liquid form, but asphalt is a solid. And so it makes it a little bit harder to allocate the costs when the basis upon which you would view them is different. Byproducts are outputs similar to scrap, if you would, that are not the primary purpose of the production process, but they are an output. So if you think about a cow and the butchering of a cow, you got the tenderloin and you got the ribeye and you got all the good stuff, and then you have something called offal. I don't know if you've seen this term before, offal. It's the kidneys and the livers and the hearts and the hoofs. It's also a product. It also has value, maybe for dog food or McDonald's. That was a joke. Nobody was listening. So for dog food or something, but it's not the same as the primary products. The split-off point. During a joint production process, the split-off point is the point when you have recognizable different products coming out of the process. Separable costs are the costs that occur after the split-off point. So separable costs would be you split off into your 2 or 3 main products, and then you have continuing processing on those products to take them to the end product that's ultimately being sold in the marketplace. That's a separable cost. Okay, let's go at it. Very simple. You have a production process that produces 2 main products with high value, 1 byproduct with lower value, and produces steam, and we only show that to say it's got no value. It just goes in the air and it's gone. So that is the output from some production process here. Examples of different joint processing. And you'll see it tends to be in the chemical industry and in the agricultural industry that you'll see a lot of joint products. Certainly milk is broken down into skim milk. You know, raw milk is broken down into skim milk and cream and butter and cheese and all these other products as well. So it happens many different times in the real world. So why are we doing an allocation on joint costs? 1, you need to for tax purposes. You need to for accounting purposes, to account for inventories, to account for cost of goods sold. You need to for management accounting purposes. You need to determine, is it worth breaking your milk down into skim milk and other products? Is the skim milk bringing you a reasonable profit? As we've seen in other allocation scenarios, you need to in the case of when you're selling to the government. Because if you're doing a cost plus project, you need to allocate the costs fairly so that you're not overcharging. Insurance settlements, similar to that, you need to establish costs in case there's a problem that you want to get an insurance settlement on, and other legal reasons similar to that. Three of the methods that we'll talk about are market-based: sales value is split off, net realizable value, and the constant gross margin. And one of them is just physical measurement. How much of each have you created? Physical measurement makes sense when the products are of the same physical size and shape, or all liquid or all solid, and their values are pretty close to each other. If the values are dramatically different, physical measure may not make sense to do. So let's start off with sales value at split off. Generally speaking, the preferred method if you can do it. You can only do it if at the split off point, if at the point when you have different products, those potentially intermediate products have some value in the marketplace so that you can establish their value. So let's do it with raw milk. You're starting off with 110,000 gallons. In order to process that raw milk, it's going to cost you $400,000 to process 110,000 gallons. And the product will be 100,000 gallons of product, 25,000 of cream, and 75,000 of skim milk. And 10,000 gallons will be byproduct or waste. Doesn't say anything here. At the split-off point, cream has a value right away, as does skim. So you can do the net value at split-off point. You produced 100,000 gallons in total. You sold 50,000. You have inventory of 50,000. And your selling price for cream is $8 a gallon, and for skim is $4 a gallon. So, an illustration of this process. Notice it's based upon production, not sales. So you produce 25,000 gallons of cream, and you produce 75,000 gallons of skim. So here's the value of what you've produced. And you can see the cream is 40% of the value, and the skim is 60% of the value. Since your joint costs were $400,000, this method says give 40% of the cost to cream and 60% of the cost to skim. The net result is cream will cost $6.40 per gallon to produce, and skim was $3.20. Since skim is being sold for $4 a gallon, you're making 80 cents a gallon on the skim, and the cream was being sold at $8 a gallon, you're making $1.60 per gallon on the cream. So that's pretty much the sales value at split-off approach. Its advantages are it's easy, and the costs are allocated based upon revenue potential. So it's pretty fair. In some industries, market values change, particularly think of oil and gas, and so it would fluctuate. And secondly, sometimes you can't use this method because some products don't have a sales value at the point of split-off. But it is the easiest method. The net realizable value method. Sometimes you don't have a value at split-off. What you need to do is look at the end value of your product. So it's split off. You do some additional processing on each of the individual products, or one of the individual products, if not both. That product has an end value after the separable costs of processing. You have to take that end value, subtract out the separable costs, the costs that were implemented just for that product, and then you can have a net realizable value at separation. And you then work with that value. So essentially what you're doing is you're working backwards from the end values to get the equivalent of a net value at split off. Your net realizable value is your final sales value minus your separable costs. Milk. You have cream and skim, and 10,000 that went somewhere. Cream, your cream, you determined it makes sense potentially to do another $280,000 worth of work on it to turn it into buttercream. And your skim, you did do another $520,000 of work on those 75,000 gallons to turn it into condensed milk. Try to follow along. So we know the costs. The joint costs were $400,000. There were individual costs for each of the final products. What we're trying to do is figure out how to allocate these joint costs to these two products. You produce in the end 20,000 and 50,000 of the product. The amount you sold doesn't matter for this analysis, and the ending inventory doesn't matter. And your selling price for buttercream is $25 a gallon. Is that what we were talking about? I think it was still a gallon. And condensed milk is $22 a gallon. So you have to determine the value at the end. What's the value of your buttercream and what's the value of your condensed milk? So the buttercream value was the 20,000 gallons times $25 per gallon, or $500,000. The condensed milk was 50,000 gallons at 22, or 1.1 mil. You subtract out the separable costs for each, and so you now have a net realizable value. This number here is the net realizable value, or the value that you're applying to that buttermilk at the point of separation. You walked it back in the process to the point of separation, and this is the value that it has to you at that point. And then you find your percentages based upon that, and you allocate your initial $400,000 that way. 110,000 versus 290,000. So the buttercream, I think we were selling it at $25 a gallon, so $6.50 profit. The condensed milk, $22 a gallon, if I remember correctly. So that's $5.80 profit per gallon. Not going to look at the income statement. Not going to focus on the gross margin of the net realizable value method. Just know that instead of doing it the way we've been doing it, what you're really looking for is you want all your products at the end to have the exact same gross margin. So you work the costs backwards to create a product that has a gross margin equal to the other joint products. And we'll just pass by that one. So we now have net realizable value method, and we have the sales point method. The physical measure method is the easiest. Essentially, you're just looking at the weight of the products or the numbers produced and dividing the cost based upon those numbers. This method only makes sense if the value at the end is approximately the same. So the milk example is good because everything's being produced in gallons. So you do have a viable product to do this with. Very simply, we know that the cream is 25% of the volume and the skim is 75%. So you allocate out the costs 25% and 75%. Simple as that. Would this be fair in this model? How many of you think it's fair? How many think it's unfair? Why is it unfair? Because the selling price is not comparable. And so skim, which only sells for $4 a gallon, is going to make no profit at all here. All the profit's going to go to the cream. So it provides greater value to your higher margin products and hurts your lower margin products. The advantages of the physical unit method: it's easy to use. It's very objective. There's no kind of manipulation going on. But it ignores the revenue producing capabilities of each product. And of course, it's impossible to use this method with oil or something that has products of different shapes and sizes. Oil is both a liquid and a solid in its end products. So in some cases, you can't even consider it. So how do you select a method? If you can use the split-off approach, you use it. It's the easiest. If simplicity is your goal and everything else is equal, so that the products are of similar quantities and values, you would use the physical methods approach. And if you cannot use the split-off approach, then you just use the NRV approach to get you back to the split-off approach. You may need to make the decision as to whether to sell here or do this further processing, create the buttermilk and the condensed milk, and create a different final product. What kind of analysis do you do to do this? What's that? You do a cost-benefit analysis using relevant costs. The relevant costs in here to determine whether this brings more value than this, and whether this brings more value than that. As you look at your relevant costs, remember the costs before separation are irrelevant. So anything happening in here is irrelevant. You don't worry about those costs. You're only worrying about these costs. Because you know you have to at least get to this point. And again, just as you do with any other relevant cost analysis, you probably are going to ignore most, if not all, fixed costs. But you need to understand. Byproducts. So you do a process, you create two products, or I think you create one product and you create a byproduct, wood chips. Notice they have, among other things, they have different ways of measurement. You're measuring this by board feet, and you're measuring this by just cubic feet of a pile of chips. The two different methods of accounting for byproducts, because they do have value. They do bring value. One, you recognize the volume, that pile of chips, as being inventory as it's created, and then you sell it in, you define costs, the time of sale, just as you do with any other product. The other method is you don't recognize the byproduct inventory because it wasn't your purpose to create that. You don't track any special costs with your byproducts. You kind of just recognize sales as they occur, and those sales reduce the costs of producing your main product. I'm not going to go through all of this detail on it. It's in the text. Okay, you guys get to do some practice now because I can tell you're ready to do. Okay, tuna. Unprocessed tuna. You caught a 14,000, is that one tuna? How big is a tuna? Is that a big tuna or is that a lot of tuna? 14,000 pounds. More than one fish, right? Yeah. That would be a whale, right? Yeah. Oh, that sounds about right. But they're big fish. So you have 14,000 pounds of unprocessed tuna with a value in its unprocessed form of $16,000. This is what you're trying to allocate. At split off, you'll have 2,000 pounds of tuna fillets, 8,000 pounds of tuna that's going to go into Bumblebee, and then 4,000 pounds of other stuff, byproducts, scraps, and waste. You can sell the tuna fillets at $2.20 a pound. This is an old example. And you can sell the canned tuna at $1.65 a pound. Using the physical units method, how much of this initial cost would you apply to each? Physical units, 10,000, 20% and 80%. So you allocate the costs in that ratio, 20% and 80% of the total $16,000 of costs. And so you're going to allocate $1.60 to each. Is this a fair way to do it for this tuna? Is the value of the end product approximately the same? No. So it's probably not the fairest way to do it. It's possible to do it because they are in the same units of measure, pounds. So it is possible, but probably not fair because the fillets are going to make you 60 cents a pound, and the canned tuna is going to make a nickel a pound based upon their selling values. Yes, sir. Yes, that's what you're doing with physical units. So, or cost per whatever unit of measure you're using. The sales value at split-off method. You have the same 10,000 units to start, broken 20 or 2,000 pounds and 8,000 pounds. You know your price per unit, so you find out your sales value at split off. 1760, which is just extending 2,000 times 220 and 8,000 times 165. So at split off, the value of the fillets is 25% of the overall value, and the value of the canned tuna is 75%. And that's reflected because of the higher selling price. So therefore, you're going to split the initial $16,000 of costs not by 80-20, but by 25-75. And the cost per pound then are $2 a pound and $1.50 a pound. In this case, the fillets will earn 20 cents a pound, and the canned tuna would earn 15 cents a pound based upon their selling prices. So, seems more reasonable. This is a reasonable approach to take in this situation, and the preferred approach. And you can do it in this situation because both tuna fillets and canned tuna have a value at the point of separation. Let's say you have a slightly different model. You have your tuna fillets, you have your canned tuna, and then you have your cat food. That 4,000 pounds that we didn't talk about before, 3,000 of those pounds are good enough to convert into cat food. If you invest another $850 into those 3,000 pounds, and then you can sell that cat food for $1.75 a pound. I'll find it interesting that you can sell the cat food for more than you can sell the bumblebee, but that's the example. Okay? Which method will we use here? The net realizable method. Now you don't have 10,000 pounds of output, you have 13,000 pounds of output. When you add in the cat food, you have the sales value when you extend by the number of pounds, or the sales price when you extend by the number of pounds, gives you the sales value. And for the cat food, we know that to get to this sales value, you had to invest $850. So to do an apples-to-apples comparison, to look at what the values would be at the point of separation, you can still use the values you had for the tuna fillets and the canned tuna, but you have to work the cat food back from its final price or final value to its net realizable value. So you subtract the $850 from its final sales value of $5,250. So your overall value of your three products at separation, or your net realizable value, will be $22,000, which miraculously worked out to 20-60-20. You can then allocate your 16,000 in this ratio. It goes, at this point, it goes just the same way as the previous method. And the total cost, just you add back in the $850 for the cat food, and you see the cost to produce per pound of each. And that is the net realizable value method in action. Sometimes the net realizable value method can work. Sometimes all the products need to be worked back. In this example, only the cat food needed to be worked back. Okay. That is Chapter 16. Oh. Well, no, it's not Chapter 16. Sorry about that. There's more. here are two that you do get to do, for real. You have a total joint cost of $100,000. You have your sales values that split off and your units that split off. If I ask you what's the best way to do this, which is the best way to do this? Sales value at split off? Go ahead and do it. Find the sale, using the sales value at split off method, allocate the $100,000. How much is allocated to product 1? $65,000, 65% of the total cost. Product 2? $25,000, and product 3? $10,000. Same problem, you want to do it the easiest way. What will you do? The easiest way is by volume. So we'd use the units at split off rather than the other. Why don't we quickly do that one? What's the first product? Second product? 40,000, last one 50,000. Okay. Now we're done. When we take a break until 25 of